Hey guys, Joel Frank here, market analyst for YouTrading, taking over the podcast this week. Let's jump straight into it, take a look at markets. I've got all these charts here on 1 day candlesticks, so we can sort of look at the big picture of these asset classes as 2022 gets underway. So, by the way, guys, hope you had a great New Year and a great Christmas. But anyway, back to markets. In the top left, you can see I've got the dollar index, the Dixie. And you can see it's kind of been, well, it's been trading within a 95.50 to sort of 97-ish range in the last couple of weeks. It's been ebbing a little bit lower. As you can see, if you look over at this chart to the right, that's the S&P 500, things have been very, very risk on. And if you look just below it, oh, sorry, in the bottom left, you can see crude oil's also been moving higher. So crude oil's been moving higher, stocks have been moving higher. We'll get into that more in a second. But the dollar is a safe haven asset, or it's seen as a safe haven, so that has been weighing somewhat on the dollar. But dollar bulls will probably be happy about the fact that for now, the dollar has remained above some key levels of support, including this level here around 95.40. That was the 30th of November low. Above the 50-day moving average as well, which if you look back to October was a really good area of support. So some of the dollar bulls might be hoping that this week we find a bit of strength perhaps and push back towards recent highs. We do have a lot of US data this week, like jobs data, ISM PMIs, amongst some other data releases, but those are the most important ones. Also Fed minutes and some Fed speak. Obviously the Fed, the way things have been going, it's been much more hawkish, doubling of the QE taper earlier on this month, talking about 3 rate hikes in 2022. Potentially the minutes might reveal something about their some ideas doing the rounds about quantitative tightening. So it's all sounding quite hawkish on the Fed front. Whilst the US data is strong as well. So there is fundamentally some reason perhaps why the dollar could go higher. There might be some fatigue because the dollar has been doing pretty well in the last couple of months. So if you zoom out, first of all, if the dollar was to break below this support, that would open the door to a move under 95, which is around there, and towards these areas of support, which have been quite good in the long run. It's this low here from March 2020, then that formed like a top for the dollar for quite a long time, then that acted as resistance again. So perhaps we could end up back there if people were just basically taking profit on long dollar positions. But anyway, moving on, back to stocks. As I was saying, things have been very, very risk on in the last couple of weeks, or since the 20th of December. Remember, there's been Omicron fears, which pretty much from here through to here. So 26th of November to the 20th of December, people were very, very worried about, the impact Omicron was going to have on the global economic recovery and all this kind of stuff. What's the impact going to be on earnings? And that had been capping equity upside, and the S&P 500 had been capped at around 4,740, but then we burst through it last week, or the week before last week actually. Oh no, it was last week. Excuse me, it was the 27th. That was last Monday, so a week ago. Burst through that area of resistance because Omicron just appears like it's going to be much milder than Delta. I mean, the evidence suggests that it's 3 times less likely to result in hospitalization, approximately. Now, doesn't mean that's still not going to disrupt the global economy, but that's good news, isn't it? Of course, it's good news that this new highly transmissible variant is milder. So that's helped equities, which are now kind of just consolidating close to record highs here. We tried to get above 4,800 last week, couldn't really manage it, but we are going to see some real flows returning to the market this week. Obviously, it's the first week of the year. So potentially look for some direction, which, as things stand, could potentially be to the upside. And there's no real resistance because we're at all-time highs. So let's just see how things happen. A lot of people thinking things might be a bit more volatile this year, with the Fed potentially tightening, amongst other things. But anyway, things looking pretty good for stocks right now, above key resistance. Moving on to crude oil. Kind of a similar story. We saw that risk on surge last week where we rallied from under 70 to the mid 70s. So now we're in this range, which is like $74 to like $77 ish. Been the range we've been in for the last couple of days. We are above a key area of support here, which is 74.50. That was key support in early October and in mid-November. So kind of finding some buyers every time we dip back there. Things pretty constructive, but oil supply is growing. OPEC meeting this week, they're going to, all the sources that have been out have said they're going to press ahead with another 400,000 barrel per day increase in February. US output is rising as well. So crude oil markets, although the global economic recovery does continue and Omicron isn't seen as going to be such a massive impact, which, by the way, this was the Omicron drop, and we've actually recovered all of that, or practically all of that drop. So Omicron not really seen as much of an issue, but yeah, because supply is increasing, oil markets aren't as tight as they were, during October. So it's going to be difficult, I think, for oil to get back to these sorts of levels above the 80 mark. But we will see. Risk appetite remains pretty good, so we could see oil advancing. So in terms of gold, finally, gold's been kind of ebbing higher in recent weeks, despite all the hawkishness from the Fed. Some people talking about Omicron safe haven bid, but just looking at equities, I hope my head wasn't blocking the S&P 500 then. But yeah, looking at equities and oil, things have been pretty risk on, so I don't think it's a safe haven bid. What it is US real yields have been ebbing lower because in the long run, markets are still very much of the idea that Fed policy is going to be very accommodative, and the Fed is probably going to keep interest rates well below the average level of inflation in the long run, which is why long-term real yields are deeply negative and remain so. And that is keeping gold supported. So let's zoom out a bit on gold, just some sort of long-term technicals here. You can see we're kind of consolidating within, maybe you could call it a descending triangle. Maybe I'm reading too much into things, but look at this downtrend that we've had going all the way back to November last year. Well, we're moving back towards another test. And, either we find a lot of sellers, which is possible, we're going to have a hawkish Fed this year, higher interest rates in the US. That could be a big negative for gold and push it back to test these recent lows. But then, purely from a technical standpoint, if we did break above it, well, then we could be in for a test of the 1900 level and these highs, or even, back to near 2000, where these highs are. Anyway, what else have we got on the calendar this week? I already spoke about ISM the US ISM surveys, so manufacturing PMI on Tuesday, services PMI Thursday, obviously non-farm employment change, non-farm payrolls basically, but also the unemployment rate's really important at the moment as well. Look how low that is expected to come in, 4.1%. Wow. The impact of the spread of Omicron is not likely to have impacted this data yet. In January, it will show up, I think. So look for some weak numbers in January. But people think Omicron is going to be temporary, so that shouldn't cause any massive problems, I don't think. But in the meantime, the US data should be strong. What else we got? We've got Canadian jobs data 2 for the loony traders to keep an eye on. Fed minutes, just back to the US type stuff. Obviously, hawkish Fed shift. Let's see what some of the opinions regarding that was. And some of the things that we're quite interested in hearing about now is the potential for Fed quantitative tightening, because remember, their QE program is going to end in March, and they're probably going to want to start ending their reinvestments, because at the moment, okay, maybe their net buying will be over, but every time a bond matures, they're still committing to reinvesting that principal in new bonds. So there is still going to be QE going on to maintain the size of the balance sheet. So yeah, anything about quantitative tightening that would see the size of the balance sheet reduced. Also on Wednesday, keep an eye on the ADP because that obviously is used as a gauge for the NFP. On Friday, what else we got? I mean, that really is the most important thing of the week. It hasn't come up on this calendar, but we do have flash Eurozone inflation numbers. I believe that is on Thursday. And that should be quite interesting. Obviously, there's a big debate in the Eurozone at the moment on the ECB. The hawks think that the ECB is underestimating inflationary pressures in the long run. We will see. You need to watch every single one of these Eurozone inflation numbers. The euro hasn't been too moved by them, but it will be interesting. OPEC also on Tuesday. But that's pretty much it, guys. That is pretty much it. But some Fed speak probably worth keeping an eye on too. Hope you enjoyed the podcast, and I'll see you all next week.